This is John Martinka, and welcome to the Getting the Deal Done podcast series. And my special guest today is someone I have known for about 20 years, Bill Hanlin, a certified public accountant and an expert in business valuation. Welcome, Bill.
Thank you, John. Happy to be here.
Bill is with the firm Hanlin Moss Yee. Susan Yee is his wife. And the website is Hanlin, HANLINMOSSYI.com. They do taxes. He does business valuations. They have an office in China that is for American companies that do business and have a location in China, as well as serving Chinese residents who have assets and business here in the United States. So, Bill, let's start out and talk about business valuations for the small to lower middle market size range. Obviously, we all look at financial statements. What do you concentrate on besides those financial statements?
Well, business valuation really is an exercise in providing both the buyer and the seller of value based on expected future earnings or value of assets in the future. So the financial statements, of course, are historical, and they'll tell you, well, this is what we have made and this is what we have had. So the exercise of a business valuation is, what do we look like tomorrow after a transaction is completed in terms of the ability for the new investor to make money? Okay. So we concentrate on all those things that measure risk. What's happening in the economy? COVID was a big one for a while. What's happening with the industry? Is it evolving? Is it changing? Is it stable? What's happening with the owners? Are they micromanagers, or are they going to leave behind a team that will be able to pick that business up and run with it while the new owner figures out what's going on? So it's all about analysis of risk, but the financial statements play a big part in that because it's a roadmap of where the company has been.
Okay. When we look at the statements and we look at the earnings, and a common term is EBITDA, earnings before interest, taxes, depreciation, and amortization. Tell me how you use that, say, versus free cash flow, and say net income from operations, etc. Because there's an alphabet soup of earnings acronyms.
There's an alphabet soup, and depending on who you're talking to, one of those is going to be important. To most people, net income is pretty important. That'd be net income after taxes, regardless of whether the entity is one that pays taxes or not. For someone else, EBITDA can be more important. This is especially true in the merger and acquisition market. And just as a side note to that, most valuation work, not just in the United States, but around the world, is conducted for merger and acquisition transactions. It has been for the last 40 years and probably will continue to be regardless of the specializations. Now, free cash flow isn't a new term, but it's an important term, especially to lenders. Lenders want to know if there's going to be enough money produced by the business to make the payments on the debt, and the debt payments include interest and principal. So while there's some calculations that go into what's the tax on the earnings, which includes a deduction for the interest expense, it doesn't include deduction for the principal. So more and more lenders, especially mezzanine lenders, banks that grant SBA loans, etc., they want to know about this free cash flow. How much money is left over after paying the bank's payment? And is there enough money after giving reasonable consideration for compensation to the owner for running the business in order for them to justify lending the money to the buyer? So,
okay, thank you.
Yeah, it depends on your audience, but free cash flows become important to lenders.
So we talked about EBITDA. I used the term, and depreciation is a big part of that. Let's talk about depreciation. And there's, your regular depreciation over the, allowed for life of the asset. There's Section 179, there's a bonus depreciation, as you've told me, on qualified property. Talk a little bit about that and how you would handle that, when an owner should use those accelerations, et cetera.
Well, an ongoing business that is acquiring new equipment or even doing tenant improvements to a building is afforded several opportunities for depreciation in the year that those assets go into service. One is they can depreciate it over an estimated useful life. And that's mostly in tables that are published by the Internal Revenue Service. You know, if you bought a truck, what's the estimated useful life? If you bought a computer, what's the estimated useful life? But there are a couple of provisions that have actually been available to business taxpayers for quite a number of years. One of those is Section 179. Section 179 came in when the economy was stagnant and manufacturers were saying, you know, people aren't buying from us, businesses aren't buying, and we need some help. So Congress passed this Section 179 saying, if you buy assets for your business, non-real estate assets, then you can write them off up to a certain dollar value all at once, instead of writing them off over 5, 7, 10, or 20 years. And that suited the intended purpose of getting money moving into capital investments for businesses. Bonus depreciation is sort of like a Section 179 on steroids. It's bigger. It has almost unlimited amounts that can be written off in that first year of putting an asset into depreciation or into service, and includes real estate type assets. Now, it wouldn't be the building itself, but it could be electrical systems or plumbing systems or wiring systems, you know, or telephone or security systems, big ticket items that cost lots of money to put into a building. In fact, there's even a section in 179 and bonus depreciation that if you buy a building and you do tenant improvements on the interior up to $2 million, you can write it all off that first year. So in anticipation, why would a business want to do this when it makes the value of their assets on their balance sheet go down? Well, first of all, these are tax benefits. And even if writing off a large investment like this, and maybe it was financed, so you write the whole investment off because it's allowed by law, and it might not be allowed next year because Congress is kind of funny about passing last-minute tax legislation that is a surprise to everybody. And how would you like to be surprised and find out this asset that you put into use that should have a 15-year life normally, and you could have written it all off this year, next year you can't write but 1/15 off, even though you've already declared that this asset should be written off faster. That's not useful. On the balance sheet, on the other hand, a published balance sheet other than the one on the tax return is not obligated to use tax depreciation. You could take your $500,000 investment in, say, land mover or dump trucks or something like that. And, it's amazing the cost of capital equipment these days. And you could write it all off for tax purposes and not write it all off for book purposes because it's allowed. It's not in conflict with the Internal Revenue Code. And it shows a higher value on your balance sheet because you haven't taken all that depreciation for book purposes. Now, there's some things that have to happen on subsequent tax returns that now don't have that depreciation, but the books do. But this is how we handle it for many, many of our business clients, so that they're not showing that there's no value on the balance sheet to their property and equipment. So that's long and short, John.
Very interesting, Bill. I'm just going to share that when we look at a deal with either a client who's a buyer or a seller, what we want to get out is, when are there going to have to be capital expenditures? Doesn't matter what they wrote off. It's when is the buyer going to start spending money on that stuff?
That's right. And frankly, that's part of the free cash flow analysis.
Yes.
It isn't what's the income and expense, it's what's the cash flow. Right? You expect this much in sales, you expect this kind of profit after tax, but what else do you have to do? Do you have to increase working capital because your business is growing? Do you have to replenish or rebuy new capital assets or upgrade for new technology? These are business decisions and not just tax related decisions. But you're right. What's happening with the cash flows? We like to see a projection that goes out 4 years, and there's a reason we go 4 years. In IPOs, the SEC wanted 10 years of projections forever. And I always thought 10 years of projections were nonsense because I have no idea what I'm going to be doing 10 years from now on this day, whether I'm here or not. So they gradually came to the conclusion, well, maybe there's some argument for that. So they dropped it to 5 years, and now they allow 4 years. So we kind of use a 4-year projection benchmark when we're doing valuation. And it absolutely requires the involvement of management because we can't do those projections. John, I know in your experience, you've come across this too. Management runs their business, but they've never done a budget, which means they've never thought about, well, what are we going to sell next year? And what kind of our costs are going to go up or down next year? If we can get management to do that and tell us how they get to next year, we can extrapolate and go out another 3 years, subject to their approval. But it is an exercise in projections when it comes to opining a value on a business based on projections. And it's always a challenge.
It is, yeah. You mentioned economic situation as part of the analysis. What we've gone through recently with COVID, how do you handle those tailwinds or a company that's had headwinds?
Well, this has been an interesting discussion amongst myself and my colleagues from not just the United States, but also in other parts of the world. We've done valuations for companies that just made a fortune during COVID. They were in the right place at the right time where people just absolutely had to have what they have. We've also done work for companies like I think the majority of companies that experienced serious slowdowns, had to lay people off or delay buying inventory or all kinds of things. But what we're finding, and by the way, there's a McKinsey study on this for when it's expected certain sectors of the economy to come back to pre-COVID business volumes, and it's different by sector. They haven't updated it. It's now 2.5 years old. And we will look at that and we'll talk to management. Okay, you've had a downturn in your business and now you're selling. When do you expect this business to come back to normal? They're closer to it than we are. They're much more of an expert in their business than we are. We'll also look at other things, say in the domestic market. We did a valuation about a year ago for a company that does staging. They put furniture in your house so that a potential buyer can see what it might look like if they bought that house. And they had a downturn, but it was small. But people still wanted to sell their homes. And after about a 6-month downturn, they went not only back to pre-COVID levels, but farther, because the urgency, it seemed, for people to sell their homes so they could move into newer homes or move out of the area or put their money into retirement or whatever became more urgent. And those guys did well. Now, we've also done work for a company that was doing massive imports of masks and gowns and covers and all those things that suddenly became absolutely essential for healthcare workers to have during the height of COVID treatment. And this last year, they posted a small loss. The volume was less than half, but more importantly, it isn't just the volume that made a difference. It's also it took them time to rescale their business to the lower volumes. They weren't prepared for the increase, but they staffed up for it and they made it happen. They also were not prepared for the decrease. So if we were to value this particular company for sale, we might just take those 2 years out. Say this is not part of normal earnings. And in the valuation profession, you can do that as long as you explain, okay, well, we're going to ignore this year. Typically, we'll have a business that has 4 years of history, and say year 2 or 3 is a loss, and they've got 20 different reasons why it was a loss. But for us to restate that loss to something positive is really just a guess. So we leave it out. We don't include it in the weighting, but we explain, look, these guys had a loss. You can see that they've recovered. We're going to give more weight to the most recent year as the most likely to reoccur, but we explain it. That's how we deal with the COVID ins and outs.
Great, thank you. You mentioned before that the bulk of business valuations done around the world are for M&A.
Right.
But we take out divorces and estate tax disputes and things like that, and we talk about a valuation for a buy-sell deal versus a company wants one for planning, or the owner wants one to know where they are for when can they retire. Is there much difference in those kind of valuations, or are they all done the same?
They're really all done the same, regardless of that particular purpose. Interesting, you should mention people who are planning for retirement. Nobody used to plan for retirement. And I think that's one of the reasons that so many small businesses never sold, because the owner couldn't find anybody that would operate it the way they did. So more and more, we're being asked to consult on what value might be today, and then make recommendations for what might be done to increase value, reduce risk into the future. It might be something as simple as having some kind of structured mid-management that's never existed before, because as most small businesses run today, they're micromanaged by one person who started the business and is still the head. And if that person was gone, well, nobody else knows enough to keep that business running the same way. There might also be some things that could increase profitability. Okay, well, if you had this new computer program to help you with just-in-time inventory, you could reduce some of your carrying costs and therefore increase your profits.
Mm-hmm.
Sometimes it's as simple as telling people, look, you're still using Windows 7, and you have a horrid hacking risk here that a buyer is going to say, well, I've got to spend money to, improve the security of the data for this company. And, I expect you to discount the price accordingly. Whereas if it's done on a controlled basis over the next two years or so, then they wouldn't have to give something up at the time of sale because of an obvious risk deficiency for that particular business. We have more and more clients coming to us for exactly what you're talking about, John, planning for, well, what am I going to do, or what's going to happen if I want to retire, or what if I die?
Yeah. What you just mentioned, Bill, about the owner being the one person who can do things no one else can, and do some of them, we call that an owner dependency. And that is high on the risk list. But let's carry on this. I have two more things, and one of them ties into what you were just talking about. What are the things these business owners can do to increase value, and just say over what is a reasonable time period that you want to see that they've done things, and then you can track them to say, yes, it worked.
Well, the end of that is the question: how long? I think 3 years is a good time. Look, even in our firm, and we think we do things on a very structured basis. We're looking at some software change to increase our own efficiency and productivity. But it's a big project. First, we're not going to even start it until maybe June next year, and then working with the people that we're going to buy this software from, they're telling us take 3 or 4 months for implementation. Well, 3 or 4 months isn't a long period of time, but it is when you're already busy, because it means you have to carve it out. And that's true for virtually every business: small business, medium-sized business, big business. Making time to create infrastructure changes has to be deliberate, has to be planned, and has to be with a plan that's going to set milestones with expectations for people to hit those. And most business owners especially small business owners, they're already busy. They're busy taking care of customers and hiring, firing employees and keeping track of inventories and, and lease obligations for, can we stay in our business location or do we have to move? And da 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 da. Even buying a new phone system can be a 3-month project. So if you try and rush somebody through suggestions for how to reduce risk or increase profitability or both, there has to be enough time, and the owner has to know that they can feel comfortable that they've got enough time to get these things in. If you tell them it's got to be done in 3 to 6 months, most of them just won't do it. They just, it's too much work. It's too much trouble. I don't want to do it. But if you, the consultant, can sit there and say, look, if you do these things, you have a strong chance of increasing the value of your business 10 to 50%. Most of them are going to listen to that. It's well known that people who own businesses, generally, it's their biggest asset. It's not their house, not their cars, not their retirement accounts. It's their business. And if they monetize that someday by selling it to somebody else, whether it's inside or to a third party or whatever, then the family is going to miss out on the legacy, the monetary legacy that owner has created. And I think that's really too bad. You and I both know that most small businesses don't get sold. There's no plan. And it's sold after the owner has died and the surviving family doesn't really know how to run the business and doesn't know how to find somebody that would pay them a fair value for it. And that's really too bad.
Yeah, I have seen multiple cases where usually it's dad died and one of the kids took over or the spouse took over and they don't know what they're doing and it wasn't pretty.
Yeah.
I want to finish up with something that's really confusing for me, and I don't know if there's an easy answer, but people will say, well, what's the basis in the business? And I go, that is way above my accounting pay grade. It is not an easy calculation, is it?
Well, actually, the concept of basis is simple, but if you don't keep track of it as you go along, then you're right, it can be complicated. So in our firm, I'm a teacher. I teach new staff and experienced staff tax concepts. And we've been this last couple of years spending a great deal of time on basis because the IRS now requires annual tax returns to submit schedules that show what the basis of shareholders and partners are. So basis is simply this. It's the money you put in plus the money that you make minus the money that you take out. And if there's anything left, then you have basis. Some business owners are lucky enough to put money in, have their business make money, and then they take it out as it's being made. And if the business is doing well, then they're doing really well. And they leave a certain level of capital in the business, and that becomes their basis. It's important to keep track of basis now more than ever, because if a partner or shareholder in a subchapter S should take out more than their basis, the current revenue code requires them to pay capital gains tax on that excess distribution. Now, years past, say years prior to last year, when the IRS did not enforce this basis disclosure information, businesses would have losses and partners and shareholders would take their share of the loss on their personal return. It's not allowed, but they would do it anyway, and the IRS had no means to follow it up. Now requiring these basis statements and forms to go with that subchapter S return or that 1065 gives the IRS a database of basis. So if somebody has taken money out and it doesn't show on their K1 that there's an amount in excess of basis for them to pay tax on, the IRS has a means to catch it and to come up with a letter saying, oh, you know what? We think you should have reported this amount as a distribution in excess of your basis. Give us the 20%. Oh, and by the way, penalties and interest. Then the onus is on the individual taxpayer to show that the IRS is wrong. But generally, they're going to be right because practitioners such as ourselves who do these basis calculations and submit them to the Internal Revenue Service with those business returns, It's just like W-2s now. W-2s go in. If you don't report your W-2 income, the IRS knows about it. And they come back and they say, oh, we don't think you reported all your income. So John, it's there. Basis is not difficult, but it has to be, you have to do it as you go along. Otherwise it becomes quite the little puzzle to figure out the prior year to where are we today.
Good. Thank you so much, Bill. And again, I'm with Bill Hanlin with Hanlin Moss Yee in Seattle. Bill is a tax expert and definitely a business valuation expert, one of my go-to people on that, definitely the top go-to person on that when something is needed. Bill, I really appreciate your being here. Thank you so much.
John, anytime. Thank you very much. And I'll
Right.
look forward to talking to you soon.